It's impossible to turn on the news these days without hearing that the housing market is likely to collapse. Are we about to enter a housing bubble? Will the market fall or, at the very least, deflate in the near future? When will rocketing housing prices ease? And what should homebuyers do? Stay tuned as we will be answering all these questions. Hey folks, welcome to Business Bro. If you are new here, you must know that we are giving away 1,000 Dogecoin to our random subscribers. All you need to do is like the video, subscribe, and comment on your favorite crypto coin in the comment section. Good luck! With that being said, let's dive into the video. When there is a widespread perception that today's robust price increases will continue, the housing market becomes unhinged from those fundamentals. If a large number of purchasers share this belief, purchases motivated by a fear of missing out can drive up prices and raise expectations for big price increases. A decline in the economy does not qualify as a recession until it lasts at least 6 months. Between 1945 and 2009, the National Bureau of Economic Research recorded 12 recessions. The shortest was 6 months and the longest was 18 months, for an average of little over 11 months. Whether your home's value has plummeted as a result of the recession and you have the time to wait, you might want to put off the sale for a year and see if the market swings back in your favor. Despite the fact that the current housing market is exceptional, there is no reason to believe that the consequences of a housing correction will be equal to the severity of the 2007 to 2009 crisis. If you are expecting a significant downturn to get a better deal on a home, don't hold your breath. For various reasons, most housing specialists believe the market will continue to be robust for some time. Number 1, housing demand among millennials is increasing, with Gen Z close behind. The quantity of potential homebuyers is numerous, with millennials and younger Americans accounting for half of the U.S. population, or 166 million people, as of July 2019. This is crucial because, according to data from the National Association of Realtors, first-time homebuyers account for the biggest number of persons buying homes, 31%. Furthermore, the majority of first-time buyers are under the age of 40, indicating a large buyer pool, a promising sign that demand will continue to be robust, especially when housing inventory is at historic lows. We are unlikely to witness a decline because the housing market has seen little inventory growth in the last 10 years. In a few years, Gen Z will hit 30 and will be more financially prepared to buy a home than millennials were when they were their age. This suggests that demand for homes will be as high, if not higher, than supply, with supply still falling behind demand. Number 2, there isn't enough supply to meet demand. The extremely low supply is also assisting fuel demand and higher home prices, which is another reason why housing experts believe the market will continue to be robust for many years. The primary cause for the rapid rise in property prices is a supply-demand imbalance, and after a decade of not building nearly enough homes, it will take at least a few years for home builders to bring in enough new supply to bring the market back into equilibrium. In a balanced market, the months of supply would be roughly 6 months, the amount of time it would take to sell all of the homes on the market at the current rate. Today's market, on the other hand, has only 1.7 months of supply, indicating a significant imbalance in favor of sellers. The fact that new home development increased at an annual rate of 6.8% in February, the fastest since 2006, is encouraging. The approximately 1.8 million new home starts, on the other hand, are unlikely to affect home values. It will take time to pay down the debt we have accrued on our housing portfolio. Even if housing prices moderate from their peak in 2021, the imbalance will continue to put upward pressure on them. Number 3, borrowers are less likely to fail to pay back their loans. One of the key distinctions between today's housing market and the one that existed prior to the 2008 housing disaster is that lending standards have tightened as a result of lessons gained and new rules established in the aftermath of the previous crisis. That is to say, people who are authorized for a mortgage today are less likely to default than those who were approved prior to the financial crisis. It's difficult to find a lender today that offers so-called no-doc loans, in which the borrower is not required to produce proof of income as was the case before the housing meltdown. Furthermore, many government-backed loans include a set of criteria, such as a minimum credit score and a down payment. And, among other things, regulators now want lenders to check a borrower's ability to repay the loan. In the fourth quarter of 2021, more than $1 trillion in new mortgages were originated, with 67% of those mortgages going to borrowers with credit scores above 760. According to FICO, this score is regarded as extremely good. Lending criteria have tightened, and new mortgage credit scores are now significantly higher than they were in the early 2000s. What's more likely is a gradual slowdown in price appreciation, with home values continuing to rise but at a slower rate than they are currently. Number 4. Signs that the housing market is about to collapse. The rumblings of a recession have broken through the surface of what many analysts consider to be a strong economy. Last year, when consumer prices began to rise, inflation began to rise, raising alarm bells. In March, the Federal Reserve hiked its federal fund rate in reaction to rising inflation, the first boost in 3 years and a sign of a possible slowdown. While the federal funds rate had no direct effect on long-term mortgage rates, it does influence short-term rates such as credit cards and adjustable rate mortgages, or ARMs. Consumer spending could be slowed by higher interest rates. According to Goldman Sachs, the U.S. economy would only grow by 1.75% by the end of 2022. Furthermore, Goldman Sachs Group researchers predict that the economy will enter a recession with a 35% possibility of affecting the property market. Number 5. Ukraine's war with Russia isn't going to help the economy. Energy prices, which were already rising, are expected to rise even more now that Russia's oil has been blacklisted by the US and the Eurozone as a result of its invasion of Ukraine. Increased energy prices will stoke inflation, which, along with higher interest rates, may drive individuals to cut back on their spending. As a result, people may lose interest in purchasing a property. According to the latest Consumer Sentiment Index from the University of Michigan, consumer confidence fell to a 10-year low in March. In March, the index dropped 30% from the previous year to 59.4. Respondents were concerned about the impact of Russia's invasion of Ukraine on the U.S. economy, as well as high inflation and oil price increases, according to the study. The ripple impact of the U.S. oil embargo on Russia might aggravate supply chain issues, contributing to already high inflation. As the cost of goods grows, consumers are less comfortable making significant purchases, such as buying a home. Geopolitical tensions appear to be the wild card, with the potential to exacerbate inflation, which is predicted to last longer than expected. As a result, the Federal Reserve is projected to begin withdrawing its accommodative policies, including interest rate hikes. Rate hikes that are too aggressive could cause a significant downturn, especially in the housing markets if mortgage rates rise too high. What should home buyers do? In today's market, home buyers must make difficult decisions. Home prices are expected to continue to grow, while new home production is expected to lag, putting purchasers in a tight housing situation for the foreseeable future. For some buyers, this means relocating from large cities to smaller, more affordable urban areas. Others will have to stretch their budget or make sacrifices in terms of space or other luxuries. There are some purchasers who are willing to take a chance and waive crucial stipulations, such as the house inspection, in order to increase the value of their offer. This could wind up costing them more in the long run if the house turns out to have severe issues that the seller fails to notice and remedy during the inspection. On the other side, securing a home now, even if it means foregoing other expenditures, may result in cost savings in the future if home values and equity continue to climb. They may also be able to save money by purchasing a property and locking in a rate before both rates and housing prices rise. On the other hand, when there's a possibility that low supply combined with growing inflation would weaken the housing market and cause prices to decline, especially if the economy enters a recession, the converse can be true. We risk feeding the fires of inflation rather than extinguishing them if we do not address housing supply problems. High inflation and economic recession could be the result of stagflation, a term most of us haven't heard in a generation. This would wreak havoc on the housing market and exacerbate our current housing supply shortages. If home values fall dramatically, buyers may find themselves with underwater mortgages, forcing them to either stay in the house until the market recovers or sell and lose money. Even though housing experts believe this scenario is rare, it should not be discounted. When purchasers are faced with bidding wars or even paying more than the appraised value of a home, this comes into play. While there are times when this strategy should be used, it must be carefully considered if the home, neighborhood, and amount of time you expect to stay in that place will be worth it in the long run. Another significant factor to consider in this market is how long you intend to live there. People buying their forever home have less to fear if the market turns around, since they can ride out the ups and downs. Buyers who want to move in a few years face a greater risk if the market falls. That's why it's critical to start looking for a realtor and lender who are both experienced housing specialists in your target market and whom you can rely on for reliable guidance. Human greed and a lack of judgment are the root causes of the subprime mortgage crisis. Banks, hedge funds, investment houses, rating agencies, homeowners, investors, and insurance companies were the main actors. Even individuals who couldn't afford loans were lent to by the banks. People took out loans to buy properties they couldn't truly afford. Investors raised the demand for subprime mortgages by creating a market for low-cost MBS. These were packaged into derivatives and marketed to financial traders and institutions as insured investments. People defaulted on their loans that were packaged in derivatives when the housing market grew saturated and interest rates began to climb. This is how the housing market crisis pushed the financial industry to its knees and triggered the Great Recession of 2008. But that's pretty much all there is to it. Is it, therefore, a good time to invest in real estate? No, because the market is slightly overpriced and a correction is possible next year. Nevertheless, timing the market isn't a good idea either, especially in the property market, because house prices don't fluctuate as much as stock prices do, so you may have to wait a few more years. With this, we have come to an end. Do let us know in the comments section below. Subscribe for more content just like this one and share it with your friends. Also, don't forget to smash that like button and also press the bell icon to get notified about our new videos. Until then,